At first glance, today's market looks strong. SPY and QQQ are pushing higher. Buyers are in control, and price action feels constructive. But once again, there is one market that is not confirming this move. The 10-year Treasury yield remains under pressure, drifting lower and failing to support the equity rally. And this divergence between stocks and bonds is becoming harder to ignore. In today's video, we'll break down what TNX is telling us, why SPY and QQQ can still move higher without bond confirmation, and what kind of market environment we are actually trading right now. Let's start with the bond market. The 10-year yield continues to grind lower, trading around the 4.20 area. What stands out here is the lack of momentum. This is not a panic move into bonds, but it's also not a signal of accelerating growth. The bond market is clearly in wait-and-see mode. After recent Fed commentary emphasizing data dependency, and with upcoming inflation and macro releases ahead, yields are refusing to move higher. That tells us something important. Bond traders are not buying into a strong growth narrative. They are cautious, patient, and unwilling to price in higher rates from here. And historically, that matters. Now, let's look at SPY. The S&P 500 shows solid intraday structure. After early volatility, buyers stepped in and maintained control through the session. However, this rally is not broad-based in terms of risk. We are not seeing yields rise alongside equities. We are not seeing aggressive rotation into cyclicals or value. Instead, this looks like a market that is moving higher cautiously. SPY is being pushed up by positioning and momentum, not by a clear macro confirmation. This is the type of price action that often appears late in a move, when investors are participating, but with reduced conviction. QQQ continues to outperform. Technology remains the leadership group, and once again, it's doing the heavy lifting for the broader market. But this leadership tells a specific story. Investors are not chasing economic growth. They are positioning into quality, cash flow, and perceived safety within growth. This is not classic risk-on behavior. It's selective risk-taking. As long as QQQ remains stronger than SPY, the market can stay supported. But it also means the rally is narrower than it appears on the surface. So where does that leave us? Stocks are moving higher, but bonds are not confirming the move. This is not an immediate sell signal, but it is a warning to stay disciplined. Key things to watch going forward. Does TNX stabilize or start moving higher? Can SPY hold gains without broader risk participation? And does QQQ continue to lead? For now, the market looks strong on the surface, but fragile underneath. And in environments like this, risk management matters more than prediction.